Hey there, it is Monday afternoon for me, maybe later in the week for you, Tuesday morning, but getting ready to do or starting our national market update, which we do in the middle of the month. This is where we use a resource called Keeping Current Matters to kind of give us more of a national perspective, whereas our other report is mostly focused strictly on Athens, Georgia, and the surrounding counties like Oconee and Jackson. But this is more of a national outlook, and the big thing to talk about is interest rates. That is the big narrative of the story, and really, since this information came to us on late last week, it's actually changed. So I'm going to be showing some slides, but I might be talking about things a little differently than what the slide says. So first thing, we're going to, how high will interest rates go? Because it's Monday, June 13th, and we've seen a big rise in interest rates. And is there going to be a market correction, which is what people are worried about with recession? So we're going to address those two things head on. Might take me 10 or so minutes, so bear with me. There's some important information here. And again, it's all about the mortgage rates. That's what we need to talk about right off the bat. And this is just from last week, really, or beginning of June, and how quickly it can change. This is from the chief economist at Freddie Mac. Mortgage rates continue to inch downward this week, but are still significantly higher than last year, affecting affordability and purchase demand. Heading into the summer, the potential homebuyer pool has shrunk, and the supply of homes will be on the rise. Might be a normalizing in the housing market, which is welcome. Now, due to all this economic uncertainty, as you see down here, mortgage rate is very volatile right now. These numbers are from last week when we were just above 5%. This is literally like Friday of last week. And now today, if I check in with a couple of our lenders here in town, Todd Cowart, others at Region Banks, Charlie Fleming, Joe Bishop, Alan Kennedy, those people are going to talk about being around 6%. One in particular mentioned 5.875 with discount points. But here's something to know. There's other loan products. One of them also mentioned a 10-year ARM, which is 4.75% right now. So there are other ways to get there. 10 years is a long time and not exactly a bad ARM product that might get you below 5% in the current rate. But let's keep moving on, and let's look at what rates have done since December. You can see these fixed rates, and they shot right up. Now, we knew this would be coming. Originally, people expected them to stay below 5, but I don't think anybody saw how much we were going to have this energy problem with the cost of gas, which is impacting every single thing in the economy. And so the good news was last week how level the interest rates had been since April. That was going to be a big part of this narrative. Reality is now today it's changed. Instead of being in the low fives, we're up here now looking a good bit higher at almost 6%. So that's what's changed. And we're going to see this volatility. So stick with us because they might roll back down. They might go up. It's going to be something that you're going to want to stay informed on. However, we always talk about keeping something in perspective. Let's look at the average mortgage rate, which is now above 5.7. And you can see that in all these other decades, the 70s, the 80s, even the 90s, and the 2000s, the interest rate was actually higher than it is. Now, that might change in a few days. We might get it right more in line with this number right here. But we got spoiled over the last decade because the average rate was 4.09. And while that's fantastic, we do need to keep it in perspective because bumping these interest rates up will probably help levelize or level off the fast appreciation, but we don't see it turning the market around. We just might see less transactions. Now, we talked about this before, the 10-year Treasury yield in blue, the green being the mortgage rate, they have generally trended together, average spread being about 1.7 being the difference. And we've seen that be a little different. As of last week, you see the green line here is where the mortgage rate is, 2.9 is the 10-year Treasury yield. And then let me go back because that spread was over 1.7. It was 2.2. So that's something to keep an eye on. That's something that's been a big indicator of what we see with interest rates. But we've got a real volatile inflation situation, so we could see some different things. It's our job to keep you informed on what we see happening. Are we in a housing market correction? And that is the elephant in the room that people are going to want to talk about. There's a lot of clickbait out there about it. Is that happening? So let's define what a correction is. A correction is a decline of 10% or greater in the price of a security, asset, or financial market. Well, we're not really seeing that happen. If you look at the home price forecast for 2022, across the board of all 7, the lowest one being MBA saying 5.8%. Most of them are thinking there'll probably be housing appreciation around 8%, which I would say is holding true when you balance it out in our market. And it's going to be different at different price points. The lower price homes have a chance to jump a little bit more, or sometimes the more expensive top end of the market might be holding the current price or maybe even declining slightly. And decline, I mean a rollback, not really going down. So the housing market is definitely at a turning point. We're starting to see signs of a new direction, but the ball is still in the seller's court. That is from Danielle Hell, chief economist at Realtor.com. I'd agree. What we're starting to see is, lower priced homes still getting a lot of attention, and then a more normal market time for some things at the top of the market. Ultimately, it's not going to be as frantic in the frenzy that it might have been in February and March and all the months leading up to that. Let's take a look at showing time showings because that's showing you the activity in the market. This gray is the pre-pandemic levels. Blue is since the pandemic started. And as you can see right here in 2021, and even right beforehand, the pandemic just led this buyer activity really way up, where this gray over here is much more of a normal time and still a pretty strong real estate market. 2019, 2020, we started to come down in April. We'll probably come down in June and July, and probably going to be looking a lot more like 150 and 160 versus these numbers almost to 300 of the average showing time monthly index. Existing home sales, they're still looking to be up, but we got to remember what happened in 2021 was historic and probably not sustainable. So 2021, 6.1 million existing home sales, 2020, 5.6 million. The years pre-pandemic, we were just over 5, and we're probably still going to outperform that, but we're probably going to be coming down to a little bit more normal time frame, which is good. My industry, I like things to be a little bit more normal instead of this frantic craziness we've been going through. The days on the market starting to tick up a little bit. National average now 17 days, which is funny because 17 days is still not a long time. Let me put this in perspective for you. If you don't price a property right, it's definitely going to sit. And in some cases, if you price it right, it might take more than 30 days to find the right buyer versus your expectation that you heard from your neighbor down the street. The market is a little fickle right now. Some of these properties are getting multiple offers. Some of them are having to wait a little bit to find the right buyer. But what we're not seeing is a big rollback in prices. We have seen properties that have been overpriced that have been a little too exuberant based on the market. Yeah, we're seeing that come down, but it still represents an overall big increase in equity. The number of offers, while in April it was 5.5 for average, that's going down too. Some are still getting multiple offers. Some are going to get 1 or 2. That's the way it's going to be. Now, what is ahead? It's our job to try to give you the best information that we can and explain it. We can't really predict perfectly. Nobody can, but we're going to do our best to give you the best advice on what's going on that we see. Now, this is a quote that was not that long ago from the chief economist at NBA saying mortgage rates were likely to plateau. And however, over the past, this rate spike was associated with volatility in the market. Well, this was just from last week, and we've already seen another rate hike. So it's hard to say exactly what's going to happen. But what we are hearing is we're probably going to have a little bit more pain coming on those rates, and then we might see a rollback. But the whole total home sale forecast is still way up. I know the first 6 months of the year have been really strong. You can see all of these are above 6 million. Basically, all the forecasts right now. That could change, but with the interest rates ticking up, we will see the buyer demand tick down a little bit. And this is a quote from somebody at Realtor.com. The experts don't believe that the market is in a bubble or crashes in the cards like the Great Recession, and it's still suffering from a housing crisis. I would probably agree with that, that is not the case for the housing market. What I just went to is what's called a recession. And I'm not a chief economist of anything, but I think we are in a recession. It's not coming, it's here. And people think of a recession because of 2008, 9, 10. First thing you think is housing. Well, I don't think that's the case that time, but a recession is a significant decline in economic activity across the country lasting more than a few months. Visible in real GDP. That does not mean a decline in real estate values. As you can see right here, the recessions of 1980, 81, 91, that's what got George Bush. And then 2001 and 2020, these recessions were met with an increase in housing. The only one where we saw it was when it was caused by the mortgages. What we're seeing, and that was 2008, we don't have bad mortgages out there. What's causing this recession is inflation due to energy, and the cost of energy is affecting everything. And the supply chains, it's really moving fast. So one of the things I want to end with is, recession does not really equal a housing crisis. And what you're probably going to see is more realistic expectations for the seller. Let's say in March of 22 being the peak of the market, property would have gotten $500,000. It might get 490 right now, 493. What's going to stop happening is that last one went for 200. Why don't we try 225? This one got $1 million. Why don't we try 1.2? Well, these interest rates are going to make it impossible for that rate of increase to continue. So overall, that's a good thing because we're not really going to see them roll back. That's not the projection right now, but we're going to start to see this a little bit more on price. And that would be a welcome thing to buyers and frankly, to real estate agents as a whole. But one thing that we might see is there will be less transactions. So with less transactions, who you work with is going to be very important. Be sure that you're working with somebody that is keeping you educated, that knows what's going on in the market, and has various ways to help you. Just like I mentioned with these local lenders that have products that aren't quite what you think, and you might be surprised what rate you might get in this market. As usual, look us up at 5mrealty.com. Contact anybody here, info at 5M Realty. Let us know if you need help with a home sale or a home purchase. Have a great rest of your week.